All right, all right, all right. Matt, the mortgage guy here with another rendition of Ask a Mortgage Broker Live, something to that effect, Q&A. Coming at you on July 5th. For a lot of people, today was a day off. Hoping we get at least a few dozen people joining us, asking questions. It always makes for a great show where I don't know what to expect. I don't know what questions are going to be asked, but I'm going to answer them the best I can. I really enjoy this. So thanks to everybody who's joining. If I've got any issues on my end as far as audio goes, please let me know. As you can see, this microphone's been dropped more than once. As I'm transporting it back and forth between my office and home, the gain gets turned up and down. So if it's too loud, not loud enough, something like that, please let me know. But over these next 90 to 120 minutes, we're going to jump into conversations on mortgage, the real estate market, anything that you really have that you think I might be able to give a good answer on. Please let me know. I get questions like this one all the time. I literally got an email within the last hour. I thought it was a really good question, so I might actually even make a video on it, and I'll just read it to you. Love your YouTube content. Keep up the good work. I'm in mortgage forbearance now with my 30-year fixed rate at 3.875. Excellent credit. I plan to either A, resume the payment and do a cash out refi, potentially go to 80% loan to value, or B, take advantage of the 40-year loan modification and potentially refi after that. Any advice on which I should go with? And my answer to this, and I might do it in a longer and more detailed explanation on a video that I plan to do probably later tonight or sometime tomorrow. This scenario seems like it's an either or, right? Either you're going to do a cash out refinance, exit forbearance, then do a cash out refinance, or you're going to do a loan modification, which for anybody who has seen the past videos I've done on 40-year mortgages, who have heard anything about this, this is a program or a term that's only available for the time being through modification. Lenders aren't offering 40-year mortgages just to somebody who calls and says, hey, I want to do a 40-year loan, or someone's purchasing and wants to do a 40-year loan. This is only a product that's available through loan modification. So if you're in forbearance and you're looking to get into a 40-year loan, that's something you would talk to the servicer about. You wouldn't call up your local lender and say, hey, I want to refinance and go into a 40-year loan. And so it sounds like, this email I got, they either want to do some cash out, which great. Maybe you've got some plans for that cash you're going to take out. You're going to deploy that on a rental property. You're going to do some home renovations. You got a kid going to college, whatever the need is for that cash out, right? But you either do that or you do a modification for 40 years. And the part of this question that I wanted to clarify, already sent the email reply, was that potentially refinance after that. Maybe, but here's what I've seen and here's what I advise. I've had a past client of mine talk to their current servicer and do not only a 40-year on the modification, but also bring the rate down. In that case, you're not going to bring the rate down and modify it just to go and refinance later. Treat this as if this is like the restructuring or the refinance of your loan, because there's no reason to talk to your servicer and go through this loan modification process to get a type of loan that's going to serve you, only to refinance later. There's going to be some circumstances, I'm sure, where maybe 3 or 4 years from now, you're going to hold on real quick. All right. Had some background noise. Had to deal with the background noise, and my beautiful wife told me to deal with it. So anyway, just to wrap up my whole thing on that, there's no right or wrong answer. There's no like, yes, you should do a cash out refinance, or yes, you should do a 40-year modification, but it's one or the other. Decide which one you want to do. If it's a modification, that's through the servicer, and that's through a loan. That's loan modification. If it's a refinance, then you're coming out of forbearance. You're calling a mortgage broker and saying, "Here's what I want to do," and then you talk about the structure of that loan. Right? Most anybody who comes out of forbearance, as long as you still qualify to refinance, you're eligible to do that right away. There's no more of this. You have to wait 3 months and have 3 payments being made. That was being talked about in 2020. I don't know of hardly any lenders that are doing that. Most all lenders nowadays just require you to be out of forbearance. So you're out of forbearance. You've got that past due balance from all the months you missed. You're going to talk to them about how are we going to come out of forbearance. We're going to roll them all in the back of the loan. We're going to try to pay them off for the next 12 months. You're going to pay them off lump sum right away. Nobody wants to pay off $40,000 right now, right? So most people are putting them on the back of the loan, or a lot of these modifications that are being talked about and being entered into, taking that past due balance plus the current mortgage, rolling it all together, putting it into a 40-year loan, perhaps even lowering the interest rate and things like that. So hopefully that was helpful, because I know there's going to be a ton of these folks over the next 3, 6, 9, 12 months exiting forbearance, trying to figure out what the best game plan is to do. Does it make sense to refinance if I'm at 2.75% conventional? The short answer is no. The longer answer is, what is it you're trying to accomplish with the refinance? Do you have a ton of equity and you can use 200,000 of that equity to go buy a deal? It's going to yield you 20% cash on cash returns. Well, then maybe it does make sense. If you're just trying to get the house paid off sooner and you're saying, oh, maybe I can get a 2.125 on a 10-year term or a 15-year term, does that make sense? Well, then it's going to depend on your balance. But, from just that limited amount of information we have, it's probably not going to make sense unless you've got some need that hasn't been expressed here, right? Some need for some cash out, some need to restructure the loan for other reasons, right? But in general, you're at 2.75 and you got a conventional loan, you're in a good spot. Joey, thanks for joining, man. I appreciate seeing you here. Happy belated 4th of July to you as well. I got back into town today and fired up the computer at home for the live chat. There's just something about consistency that I really think matters, right? And if I want to serve as many people as possible and impact as many people as possible, I've got to have some sort of consistency where it's every Monday, 6 p.m. and get into the flow and rhythm of that, even if it's just in town from Santa Cruz, just got the bags unpacked, and now we're firing up the home computer to get in an hour and a half to 2 hours of some good YouTube live, little Q&A action. I forgot to say good evening to Kevin. Good evening to you, brother. Good to have you here. Appreciate your support. Appreciate always seeing you here. All right, Joey. How common are credit refreshes done by lenders for clients? Lender pulled fiance's credit, middle score in the 720s. Well, here's something I'll tell you from my experience as a mortgage broker. When you say, would it be worth it to refresh repull if we get her to 740 plus soon? Here's something that lenders will do from time to time. Lenders will pull a credit report, 737, and Equifax, TransUnion, and Experian, through most of our credit vendors that we're pulling credit through, will have some sort of algorithm built in that says, here's how we raise the score. Pay your best buy down from 950 to 100 because the limit's 1,000 and having it at 950 is really hurting your credit. Now, if we're 737 and that's going to bump you up 10 points, do that, rapid rescore it or whatever it's called for that specific credit vendor. And at 740, you're going to get better terms. It's not super common, I guess, is your question, but it can be done. And the key is when you say we get her to 740, I can't tell you the number of times people have told me, oh my gosh, I've done this, I've done that. My credit's 750 plus now. We repull it 30, 45, 60 days later because maybe it's a pre-approval and they're going to go out home shopping. and it hasn't moved at all because there's so many different factors that go into it. Maybe something that's older and pulling down your credit is having just as much negative impact month after month as the positive impact of some stuff coming off. And so, long-winded way of saying, not super common, but there's certain circumstances where for sure we'll look at something. Usually is when it's close. You got a 698. Oh, let's get you above 700. Here's how we do it. Oh, you've got a 719. Here's how we get you above 720. All right, great deals. Happy 4th to you as well. Get a second home in a tourist area near me. Washington State. Well, on this one, make sure that it's second home. I had a conversation with a client last week that was looking at different areas to purchase in. And a second home is, it's not necessarily the number of miles from you, because you might live in Sacramento and say, I want a second home in, Fresno. And it's miles wise, it's far enough away, but lenders really looking at, like, is this a legitimate place where a second home would be located? For me in Sacramento, you can go to the coast. You can go to Santa Cruz. You can go to Monterey, go out there, and that would be a legitimate second home. Or you could go the other way to the mountains and buy something in Lake Tahoe, legitimate second home. So if you're in Washington State, there might be some mountainous areas or more vacation type spots, right? Where you can get the terms that you'll get with a second home purchase. 10% down, better interest rate. Or if it's just a town over that's a little bit cheaper and it's going to be an investment property, then it's considered investment property instead of second home. So you didn't even necessarily ask a question, but I answered one anyway because I thought it might be helpful. Scott Wang, good to see you, my man. I appreciate you following. I appreciate the good questions that you have. Continue to bring them because it helps me, sharpen my tools and whatnot. So your question here is it a good deal to do the 40-year loan mod after the forbearance? It depends on what you define as good deal. For a lot of people, I think it makes a ton of sense. And what I would do in your situation, Scott, because I know you've got an interest rate in the high 3s, if you're not trying to access any cash, meaning not trying to get cash out, and this home, let's say this home's going to become a rental property for you, and you're going to move out and buy a new primary within the next 3 to 5 years, then a low payment would be something that would be attractive to you because it's going to add more cash flow. If you can get the servicer, and I know you can, that's why I'm mentioning it, to not only extend you to 40 years, but also lower the interest rate, go ahead and ask them. Say, you know what, my interest rate's a little bit higher than market, so I was thinking about refinancing. What can you guys do about my interest rate? That's literally the same question clients of mine asked, and took it from where you're at in the high 3s to a 3.125 and put them in a 40-year term. It's going to save you a ton of money per month. Here's the warning. If you want to get the loan paid off in a timely fashion and you don't want to pay a ton of interest, you don't necessarily want to just pay that super low 40-year payment. Maybe you make extra payments and make it, the $500 extra per month to where it's going to pay off in 25 years. If you do move out and you turn it into a rental, I personally don't see any problem with the extra cash flow, just paying you every month, keeping that payment low while your tenants are paying it anyway. And it's different strokes for different folks. Some people want to get it paid off as soon as possible. So 40 years to them just blows their mind and it's crazy. Other people want to leverage, buy more real estate and say, hey, if I've got this super low payment on a 40-year, I've got tenants paying me $2,200 a month. This thing's going to cash flow $700 a month. Then do that. So there's no real right or wrong answer. If it was me, depending on where you're headed next, I might take it with a low interest rate just to give you the flexibility. It's just why I recommend to so many people to do a 30 instead of a 15. You have the flexibility. There's no prepayment penalty on these loans. You can pay extra towards principal and pay it off as fast as you want. There's nothing stopping you from doing that. But during different phases of your life, you might want to throttle back and only pay that minimum, which is the payment that is going to get it paid off in 40 years. So that is my long-winded answer for it can be a really good idea. Now I have to do what I started to do more often. Check. We've only got 9 likes. We got 34 people watching and 9 likes. You guys got to tell the YouTube algorithm, because the algorithm doesn't know. They don't know that we're dropping edumacation on this live. So as you guys start smashing that like button, YouTube starts to figure it out. They show it to more people. More people join. More questions are asked. More value is given, and the whole world benefits, right? So smash the like button, please, and thank you. All right. Are the requirements different for a second loan versus primary? Ha! It's funny. You talked about buying a second home, and I answered it without seeing these, and now here we are. It's like I'm psychic. So yeah, you have to put down at least 10% on a second home. Oh, you know what? Okay, so I just read through. You got 3 different questions. Might turn it into an Airbnb. Might turn it into a rental. Okay, if it's considered an investment, then if it's a single family, you can put 15% down, but you probably want to put at least 20. And then if you have the means, you even want to do 25% down, because the terms are a lot better than 20% down. But that's for an investment property. If it's a true second home, which I don't know if it was, I think you just said a second home. Like, I'm going to buy another home on top of my first. If it's a new primary, you can do a primary with 5% down while you own your first one. You can do your first primary with only 3% down. But if you already own one, you're buying another primary, you can do 5% down on a conventional loan, and turn that first one into a rental that you moved out of. Or if it's strictly a rental property, then it's going to be, like I said, a 15, 20, 25% down type of deal. So the requirements are different there's kind of 3 different buckets. There's primary residence, there's second home, which is like a vacation destination where that's going to be your second home. You're going to live in that part-time. Then there's investment property. And true investment property is like, I'm buying this and I'm renting it out. Whether that's a single family, a duplex, triplex, or fourplex, you're buying it with the sole intention of using it as a rental. All right, Mona, thanks for joining. Appreciate having you here. My 4th was great. I spent time at the beach with the fam bam in Santa Cruz, California. It was awesome. Any idea how the housing market generally behaves after a U.S. general election? Any historic trends? You know what I'm going to admit here is I have got no idea. But it's a great question, and one that after U.S. general election, housing market. I know just the person to ask this. My buddy Ryan Lundquist, who's a local appraiser and does all kinds of cool stuff on the housing market and data and trends. I'm going to ask him what he's got, and we can look back on that, because I'm really not sure. Will Crowley, thanks for joining. Sounds like you might be in the mortgage industry yourself and you're looking for how to get clients when you first start out. My best piece of advice, somebody told me this when I was first starting out: do not be an undercover loan officer. As you can imagine, there's probably some people in your life, whether that's your hairdresser or your aunt or your old baseball coach, somebody who has gone to church with your mom for 30 years. There's all these people that may need to refinance. They may be in the market to purchase. They're going to need a mortgage in the next 6-12 months. If they do not know that you do mortgage, you have very little chance of getting their business. So here's my best piece of advice to you. Don't just start screaming from the rooftops, I do mortgage, call me, call me, call me, call me. Start doing all you can to add as much value as you can. Hey, I'm getting started in mortgage, and I'd really love to be a resource for you, whether you have questions on how a refinance works or how a purchase works or how to get pre-approved, and start putting out as much content as you can on mortgage education. I mean, that's literally the reason I started doing YouTube, is I was trying to put out educational content and provide something of value rather than just ask for business, and push out as much as you can possibly do. One, it helps you become more educated, and two, and important to your question, it helps people know, oh, Will Crowley does mortgages in Raleigh, North Carolina, or wherever the heck you're at, right? So do that. It'll help you become better, and it'll help people know that you do mortgage so that you can be a resource for them when the time comes. Linda Gomez, can you please explain a HELOC? How do you apply and how does it work? Sure. I shouldn't say limited knowledge, because I know plenty about HELOCs, except for that I refer all of them out, because I don't believe that me brokering it to some of these lenders that I could do a HELOC through is the best bet for clients. But long story short, a HELOC is a home equity line of credit. So you own your house, Linda, and it's worth $400,000. You have a first mortgage for $200,000. So you've got that $200,000 in equity, and you want to borrow some money from the bank, and they're going to offer you a home equity line of credit, meaning, oh yeah, we're going to offer you a line of credit, and it won't be at 10% where it's non-secured, and we don't know if you're going to pay us back. We're going to secure it by putting a second lien on your house. And so you come to us and we give you a credit line up to $100,000 for whatever you may need, because your home was worth $400,000. We're going to go up to 75% of that value to $300,000. And with our $100,000 line and your $200,000 first, we're in a pretty good position where we're not afraid that you're going to, foreclose on this thing, because it would be silly with, $300,000-ish in debt against a $400,000 property to foreclose. So anyhow, you're going to have this $100,000 line, and every bank is different. Some will offer only adjustable rate. Some will offer some fixed rate products. But the good thing and the pros about home equity lines of credit is you're only going to pay interest when you draw the funds. You might have the $100,000 open line and you don't need it yet. You're going to do a project in 3 months from now. And so you don't draw anything from it. You don't pay any interest. Then you draw $50,000 to do a home renovation product. Once you pull the money, now you start paying interest on it. Some are interest only. Some are, there's all kinds of different ones. And I don't want to speak on that, because really where I found you could get the best home equity lines of credit are credit unions and small community banks. And they always offer different types of incentives and introductory rates, right? Where for the first 6 months, it's 1.99, or for the first 12 months, it's 2.99, whatever it is. Talk to a small community bank, talk to a community credit union, and just ask them what their terms are. But that's essentially how it works, is if you've got enough equity in your home, they're going to put a second lien on your house that sits behind your first mortgage. And with that second lien, they're going to offer you a credit line up to whatever amount they're comfortable with. Sometimes it's up to 75% of the value of your house, the combined loan to value, your first plus that equity line. Sometimes it's 80%. I know some places that go up to 90%. As you go higher, sometimes they charge higher rates. So look out for that. Loan modification rate is higher than regular 30 years fixed loan. Well, the loan modification rate is whatever the servicer deems it to be, right? And so I wouldn't expect, you can't just call them and be like, modify my loan, I'm going to take a 2.75. Because really the goal of the servicer who services your loan is to put you in a loan that you're not going to default on. And so if you don't ask for that lower rate, you won't get it. They'll just say, okay, we'll keep your rate at 3.875, Scott. We'll extend it to 40 years. Your payment's going to go down by $290 a month. You should be fine. But I've heard people have success with, hey, while we're at it, let's lower my rate. You might not get market rate. It might be slightly higher. And so if you were looking for the lowest rate possible, you might not get it from the servicer. You might have to exit forbearance and then actually do a refinance. But If it's close enough, you might do that because you're going to skip the costs associated with the refinance. And I'll say it, and I say it every single time somebody asks, refinance is not free. It costs money. The lender, the title company, and any third-party services they need, like a notary or whatnot, right? And if they say it's free, here's what they do. Instead of giving you a 2.8, they give you 2.95, that little bit higher in interest rate where you pay extra per month. The bank gives you a credit to pay for the costs, but it always costs. Nothing's free in life. Sorry. I wish it was. The marketing is pretty snazzy though. All right, Linda Fernandez, another regular. Good to see you here. Happy 4th to you. I concur, agree. Hope everyone had a happy 4th. Happy and safe 4th. Is the appraisal fee and the loan estimate different from the fee from the appraisal company? No, it's all the same one. And really what should happen is once you pay, since you pay the appraisal outside of close and it's something that you pay directly to the appraisal company, once you pay it, it should move from the line that's like paid through closing over to paid outside of closing because you'll pay it. And this is a super common question. People are like, hey, I already paid for the appraisal. Why is it still showing up in my loan estimate? Have no fear. Your final settlement statement, the appraisal will not be there. If it is there, it's moved over to the column that says paid outside of close. I mean, you've already paid it. It doesn't go into your final tally for things that you bring in at closing cost-wise. Carl, thanks for joining us. Happy to have you here. Forbearance ended in December of 2020. I've been making my mortgage payments since January of 2021. What is my best option from my lender? Well, I don't know if you can go back retroactive and be like, hey, I want to enter into a modification. If you've already exited forbearance, you might just want to call a local lender and see if a refinance makes sense. I do not believe, I think if you're going to do a modification or something like that, I think it has to be done at the time you're exiting forbearance. But hey, just like anything else, it never hurts to ask. Call them up. Hey, I exited forbearance and I'm making my payments, but it's tough. Like, what kind of modification stuff do you guys got in store for me? What kind of stuff can you offer me? It certainly doesn't hurt to ask. That's what I'd do if I was in your spot. Okay, so Joey, great question about the credit refresh. And so it says, are lenders able to repull credit pretty much whenever they want? They shouldn't be repulling it like to see if you get a better score and they can improve your terms unless you request it, right? That wouldn't be something that we would do. Part of my team and my operation is just to repull at random, right? But your second question of lenders pulling right before closing, that is true. And that's like the lender. That's probably separate from the individual like loan officer or loan officer team who's doing your loan. The lender where I send your loan to, or if it's a direct lender, the bank that is doing the loans, they're going to do a soft pull right before closing to make sure that Joey didn't go out and buy a boat. Joey didn't go out and, finance a $90,000 Cadillac Escalade or something, because that's going to hurt the debt to income ratio. And they want to make sure that the credit profile and the way they underwrote the loan credit wise matches at the end of the loan. And it's not, because here's what happens, man. If they do a soft credit pull and they're like, oh, what is this Maserati Motors? Oh, you went out and bought a $140,000 car. That could blow up a loan. So they'll do the soft pull towards the end just to make sure that the credit profile hasn't changed. Ask him about midterms as well. My memory is not reminding me what we were talking about, Mona. Oh, midterms. Okay. Midterm elections. See how it already midterms. I'm going to ask my buddy Ryan Lundquist, see what he has to say about that. And be interesting to see. It's always cool looking at stats. Keep in mind, though, that there's a lot of other stuff affecting the housing market right now. And there's a lot of other stuff that will continue to affect the housing market. historic trends around elections. I don't know how strong of an impact that's going to have. I remember too, last time I heard something about how the elections might affect mortgage interest rates, and it really it 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 didn't come through from my perspective. It was like, it didn't affect it like anybody said it would have. Joni, hello. If I buy a duplex, 2 flat, and live in one, half. Okay. You're asking if you live in part of the duplex, if that can be considered a primary. As long as you occupy it, whether, here I think you said 1.5. You would only have to occupy one for it to be considered a primary. And I've got clients who have bought a duplex, they live in one half and then rent out the other. A triplex, live in one, rent out 2. Fourplex, live in one, rent out 3. Any of those scenarios, that's considered a primary. You get really good terms because it's your primary. And so, when you talk about the term house hack, excellent way to house hack. Buy a multi-family property, live in one unit, rent out the rest. It's a great way to do it. With FHA loans, you can do 3.5% down and get into there with very little capital. With conventional loans, you've got to put more down, but you can get excellent terms, much better terms than you'd get if you were buying it as strictly an investment property. So answer to your question is yes, it can be considered a primary. Just know that the terms are going to be different. For instance, you buy a primary single family, you can put 3% down. You buy a primary duplex, the down payment, I believe, is 15% on that one. Unless you use FHA. FHA, you can do 3.5%, like I said. All right. Arnold Narcisse, thanks for joining. Can a pre-approval amount be increased if I paid down debt? Certainly can. And this is something too, once you get pre-approved, it's basically whoever you're working with saying, based on the information we have right now, you could get a loan up to $300,000 with 3% down. And let's say that's your scenario. We're factoring in all your debt. We're factoring in what you have to put down. We can always update it. And you call me 30 days from now, 45 days from now. Hey, Matt, remember that $7,200 that I owed on that vehicle loan? Yeah, we paid that off. That no longer exists. Okay, cool. I'll mark it off and omit it. I'll rerun our numbers and I'll say, okay, cool. Now we can do up to $325,000 with 3% down. If another 30 days after that goes by and you say, hey, Matt, we've been looking and really like in this area, we need to buy something in the 350 range. But the good news is my mom is willing to do some gift funds to help us with the down payment. And instead of doing 3% down, now we can do 10. Okay, cool. Now we can reanalyze the whole thing and say, okay, 10% down, that debt you have is paid off. You could buy up to $360,000 with 10% down. The mortgage insurance is lower. Whatever the numbers work out to be. I just threw out random numbers, but you can always adjust, increase the pre-approval amount. The same thing would happen if you added debt. If you came to me and got pre-approved and we said $400,000 with 5% down, you're good to go. You call me a month later, hey, Matt, we really needed a family car. We bought this car and we've got a $550 a month payment on it. We'll add that debt, reanalyze it. Okay. You still qualify, but you only buy up to about $350,000 now. So for sure, the pre-approval can be changed. And if you got pre-approved and something changes, it's a good idea to let the loan officer know if you're planning on buying. Sometimes things change and you're not buying, like no big deal. But here's what I'm doing to all my clients. I've got close to 100 that are pre-approved and shopping in some sort of stage. I call it the home buyer waiting room. I'm sending them a message every other week saying, let us know if something changed with your job, something changed with your credit profile, meaning you added debt, you removed debt, one of the two. If you've got more gift funds or down payment funds coming from somewhere else, a 401k loan or something like that. And so if you're actively looking and submitting offers, make sure that you're getting that information to loan officer team to let them know what's going on, what's changing, so that we can make our adjustments and advise correctly. Last thing I want for anybody who I've got pre-approved is them getting into contract on something that they won't be able to close on. And once you're pre-approved and ready to roll and loan officer's done their due diligence to say you're good, the only reason why you wouldn't close is if something changed. And so, let them know. Great question. Thanks for asking. All right, Kenny Kim, HELOC is hard to get with investment properties. That's a question, and the answer is yes. Do you know any lender who is dealing HELOCs with investment properties? I do not. I know that I've heard of them before, but I would say with almost absolute certainty, one, they're going to be very hard to find. Two, they're going to come with terms that are not very good. And so HELOC, this is another good one for me to write down. HELOC investment property. If anything, I think these would be something that's like a non-QM product where it's not Fannie, Freddie. It's like a portfolio product that a certain lender says, hey, we are going to write these home equity lines on investment properties and offer them at, these terms. Probably going to be more expensive, probably going to be a higher interest rate, but it's a good question because I know a lot of investors that all this equity that you've seen over the last 12, 18, 24 months, let's pull some of that out. Let's put this to work. Let's make some things happen. I've saw a lot of interesting stuff lately about how the best way to protect yourself liability wise when you own rentals is to not have a ton of equity in them. And as crazy as that may sound to some people, it's the truth, right? If you own a house that's worth 400,000, you only owe 100. Somebody slips and falls, or somebody comes after you personally and tries to sue you. If you owe 300 on that property or 350 on that property, there's a lot less meat on the bone for them to come after, right? And so people like to be in highly leveraged positions in rentals, as long as they're safe and they've got reserves and they've got other things in place from a liability perspective, so that there's not the I guess some people will call it like target on your back. When you're in California like me, where they love to litigate and people love to sue. If you have all this meat dangling off the bone of all these rental properties, you might become a target. Who knows? All right, Theo. Shout out to you, man, for consistently joining, and I appreciate you as much as you guys appreciate me doing this thing every single Monday. All right, Scott. Peace out, man. Thanks for stopping by. All right, My Serenity. We're gonna find out if you can get a HELOC on them. I know for sure I can do a cash out refinance. And if you want long-term money, I'm doing this for a ton of clients where, you can certainly do a cash out refinance to 70% loan to value. Whether or not you can do a HELOC, we're going to find out. Because like Kenny asked, we're going to search out some. If you guys find any, let me know. I know they exist. I just don't think they're very common, and I don't know the term, so I wouldn't want to speak on something that I don't know much about. Home equity lines of credit on investment properties. That's the question that we're going to find out. All right, Theo. Time frame from appraisal to loan close. From start to finish, loans are taken anywhere from 21 to 25 days. Internally, and I say 21 to 25, even though we've got some 14s and some 17s and some things closing quicker. I don't like to be the guy that's like pointing like, oh yeah, we close loans in 14 days. We close some loans in 14 days where we don't need an appraisal and everything's perfect and it's a W-2 buyer and all that. Like that's not the average, right? The average probably falls somewhere between 21 and 25 days. Your question is appraisal to loan close. So I don't know if you're talking about like, hey, once we get the appraisal back, how soon until we close? I can tell you right now, appraisals are a drag on a lot of mortgage transactions. As soon as we get it back, we're getting clear to close. We're signing the next day or the day after. So we're closing it very close to when we get the appraisal back. A lot of times because we're waiting 12, 14, 17 days to get that darn appraisal done, turned in, reviewed, cleared, and then it's like, all right, finally we can close this loan. We've got everything else. We've had everything else. We've had everything else for 10 days. We're waiting for that appraisal. So that's the question to that. Dream Vision Productions. Good to see you back. Thanks for joining. Pros and cons of a lease purchase for 2 years before fully buying home with FHA loan. I think I've talked about it in prior videos where I don't have a ton of experience with lease purchases, but other people who joined threw in their 2 cents about one, you really want to get a real estate lawyer involved. And at least from what I've seen, these lease purchases are going to require a fairly hefty down payment from you. And so you kind of get tied to the deal where if something changes where you don't want to purchase, it's like you've already put down $20, $30, $40,000 or whatever that down payment is, and usually not refundable. So be weary of that. I guess the pro would be you're not competing against 15 or 20 other offers. In a lot of markets where it's super competitive, you're already there and you're not having to compete. But you want to be really careful, because if you've got like a 2-year lease option and something happens where you can't get financing 2 years from now, then what happens to your deposit? Then what happens to all the payments you've made? More often than not, what I'm seeing too is if market rent is $1,800, you're going to pay $2,000. But they're going to say, "Oh, don't worry, it's we're charging you above market rent, but we're going to apply that $200 towards principal because this is your future house." And so a lot of stuff like the down payment and the extra principal that you're paying with a higher rent is all in the hopes and the dreams that this is your future house. If it doesn't work out, you can lose your deposit. You can lose that extra payments that you've been making. And so that would be kind of what I would look at and make sure that you're covered there. And this is a good deal. All right, Miss Taylor, good to see you back. Is there a way for one to modify the interest rate with actually refinancing and all the fees? The only way to modify and get a lower interest rate, from what I've seen, is if you're in forbearance and you ask the servicer, and the servicer can do that as part of the modification. If there was a way for anybody to just go from a 3.75 to a 2.99 without doing the refinance, everyone would do that. Nobody would refinance. Unfortunately, it's part of the gig. The good news, though, Miss Taylor, is that if a refinance makes sense, they generally pay for themselves in under 2 years. So many scenarios I've put together over these last months where we've just done a ton of refinance. I show somebody, we're going to save you $370 a month. And this all in with appraisal, with the lender, with the title, with all the fees that are quote unquote loan costs. We're looking at a total cost of $2,800. This thing is going to pay for itself in 9 months in interest savings. And so in that respect, it's well worth it when you are going to refinance. And if it's not well worth it, then you probably shouldn't touch it. But there's no easy way to just say, "Oh, I'd like to take this thing from a 3.75 to a 2.99. You would have to refinance, but you'd only do it if it made sense. Cost versus benefit analysis, like I kind of just did. Pays for itself within 8 months, 9 months, good to go. If it takes you 4 years to break even on the cost, then something you probably shouldn't be doing. I think 2 to 3 years max is kind of where I'm at with cost versus benefit analysis on a refinance, unless there's other factors. If you're pulling cash out and you're doing other projects with it, then you're not doing that same analysis, because that analysis only works if it's like, I want to lower the rate, lower the payment for monthly savings. Okay, here's how much it costs. It gets rolled into the loan, but it's still a cost. That cost versus your benefit, how long is it going to take to recoup? All right, Mona, you're on top of folks. 44 watching, only 24 likes. Since your comment, we've got more watching, 50 people watching, and 26 likes by my last count. Over to the side, I've got another monitor that's showing my screen, and I realize like I'm hand gestures. In my peripheral vision, I've got all these hand gestures going on. You guys let me know in the comments whether my hand gestures are adding value to it or if they're annoying, because they're kind of annoying me off to the side. Maybe I should keep my hands to myself, like I tell my kids. They're 4 years apart. They love each other, but they love get after each other too. My two boys. All right. Does the estimated property value matter in a refinance? Oh, the application estimated value, the appraiser never sees it. This is a really good question, because a lot of people tell me that too. I'll put an estimated property value and it'll come out on your loan estimate. And it's really just a placeholder. On a purchase, the appraiser is going to see what you're in contract at. And so that, I think, whether people like it or not, plays into it, because the appraiser like has it in their head. Okay, 488 is what this thing's in contract at. And probably for the good. They're probably trying to get to that number. But on a refinance, all they have is the comps. All they have is, the information that they're looking at that's public record. They're not looking at our forms internally and saying, okay, this lender has an estimated value of 500. Let's see what we should do with this. No, that value does not matter. So that's just a placeholder until the appraisal comes in. The appraisal comes in, can restructure the loan. You can, change your loan amount to fit to whatever, 60% loan to value you're trying to stay within, or whatever that is, but will not affect the value. All right. LB Alexander, thanks for joining. I agreed to do repairs for a lowered price. Can I change my mind and back if I think the repairs are just too much to deal with? Ooh, is this the one where you were going to do the like foundation repairs? I remember somebody who we were chatting with back and forth that was there was like a bid for a foundation structural type of repair, and you were going to get a discount. You were thinking about taking it on, and now it sounds like you're like, this is too much. I'm not trying to do all this foundation repair and get a lower price. I would think you could still get your deposit back. Here's the thing. When you enter into a real estate transaction, and granted, I'm just some guy on YouTube. This is just my personal opinion. I'm not well, I guess I do have my real estate license, so I could be a real estate agent if I wanted to be. I just don't do any real estate transactions. Even my personal ones, I hire a professional realtor because I'm not the one. I just have the license to be a mortgage broker. So here's my question to you. Do you have a loan contingency in place or an appraisal contingency in place? When you entered into the contract, you probably had, let's call it a 14-day appraisal contingency, or a 17-day loan contingency, and a 10-day inspection contingency. Whatever those are, if you haven't released those, then for sure you can get your deposit back. And in this scenario where like the loan's not going to go without these repairs being made, like you have a case all day. Like, no, I can't get the loan done. Even though you agreed to do the repairs, they might argue like, no, like you can't get the loan done unless the repairs are done, but you agreed to do the repairs. I think you can back out. Unless you did something crazy, like removed all your contingencies, said, yeah, I'm going to do the repairs. And then you got into it and you're like, oh, I don't want to do all these repairs. Follow-up questions if there is any, but I'm hoping you have contingencies in place to still be able to back out. Appreciate you, man. What's up, Zeta? Good to see you here. Faithful follower of Matt the Mortgage Guy. See you on all the videos with some good comments. What do we got here? We saw a 1-bedroom small condo in Maine. Our house is paid off in 3.5 years. Should we wait to buy when the house is paid off, or should we take a home equity line now? So what is this one bedroom small condo? This is just like a second home you want to buy? Just as something for funsies? And yeah, I guess let me know, Zeta. Is this like something you're going to move into? And you're going to leave the house you're in, or you're going to keep the house you're in and move to it, or you're going to keep your house and this is going to be a second home? My general advice on real estate is not wait and buy. It's buy and wait. Just holding on to real estate for a long time. It goes up in value, and what you owe gets less and less over time as you pay it. So my advice is probably going to be buy it now. All right, let me swing down to my boy LB Alexander just to wrap a bow on that one. See it? See my memory? Yep, that's you. Friends who know foundations think it might be a big problem. Bro, if I remember correctly, and my apologies if you're not a bro, if you're a lady, then my gal. Um, that was my initial impression, as they had like some quote like $20,000, and I'm like, a $20,000 foundation problem doesn't sound like it's a very accurate quote. And if the seller's like, oh yeah, we got a quote, look, it's only gonna be this much. Uh, um, more than likely a bigger problem than they would admit. And that's why it's best to be like, all right, you fix it. We'll buy it for X price if you fix it. But it's probably best to run for the hills. If you have your appraisal contingency in place, you're good. For sure. You're backing out. Appraisal brought up the foundation issue and we cannot get a loan done now. We out. All right, Doug. Thanks for joining us on this lovely July 5th. I bought a seasonal home at 5% for 30 years, refinanced first year to 3.625 and 15 year. I think I can pay it off in 6 years. If you're going to be making big extra principal payments and paying it off in 6 years, it probably doesn't make sense, even though you could likely get a rate on a 15 year, depending on credit and whatnot, at like 2.25, somewhere between 2.25 and 2.5. And I think it would depend on how big your loan amount is on whether it would pencil. If you owe $500,000, then a full percentage point might save you $5,000 a year in interest. And even though you're paying it off super fast, it's going to make sense. If you owe $126,000, no way. So that, to me, if I had to give an answer, is going to be the determining factor is how big is it? If it's small, the $3,000 in loan costs is not going to make it worthwhile. If it's big, then maybe so. But by paying it off in 6 years, you're just chunking off interest rapidly. And so it's likely not going to make sense unless it's a really big loan amount, because a lot of these things are fixed costs. Lenders have a 1055 flat fee, fixed cost. Most title companies, relatively fixed costs. Appraisal, fixed cost. And so on a $126,000 loan, that $3,000 is expensive. On a $500,000 loan, that $3,000 is not that much, especially if you're going to save $4,000 or $5,000 per year in interest. So let me know how much you owe, and then I'll make a on the fly determination on what I think on that one. HELOC on investment property, Flagstar. Flagstar Bank. I wonder if that product, Theo, is like direct to them, or if I could actually broker to them, because I can broker to Flagstar, and they've got pretty good jumbo rates. But maybe I'll reach out to my account exec and ask him about a HELOC on investment property. See, here's the thing too: if the rates are rough, if rates and terms are rough, what you might want to do, and like I'm doing with a ton of clients, you can do a cash out refinance on an investment property to 70% loan to value and get something in the mid threes. So, if it's going to be expensive and terrible rates, and especially if it's going to be adjustable, let me put you into a 30 at 3.625 on a cash out. That'll be good looking. And I mean, long-term low interest debt right now is very, very nice. I would look for more of it if I could. If I don't qualify for a partial claim because I'm almost $12,000 in arrears, you should qualify for a partial claim, meaning you should be able to put it on the back end of your loan. For sure. Don't let your servicer push you into something that's not going to benefit you, because I can tell you with absolute certainty, the CFPB and the powers that be are telling servicers you need to work with clients. You need to work with borrowers to make sure they're not put in a bad position and they're at risk of foreclosing. So keep pushing back, Carl, on the servicer. Make them lower your rate. Make them give you a 40-year term if it's necessary. Wrap all that stuff together. And I would think that they want to work with you. They have to work with you. All right, Joey. I know most house hacks are for 2 to 4 units. Yeah, you know what, Joey? I'm in Sacramento, and so I'm only about an hour and a half from the Bay Area in San Francisco, and there's tons of people that do single family house hacks in the Bay Area. It's super, super common. And anybody who follows Bigger Pockets knows David Green and his real estate team. David Green's the co-host of that show now, and he's got a team that really specializes in investment property stuff. I got a few folks who contacted me through my YouTube channel and wanted to buy stuff in the Bay Area. I, in turn, contacted somebody on David Green's team and helped a client of mine. A client of mine bought something that was actually a small single family with a ADU, accessory dwelling unit. If you're not in California, you might not be that familiar with the ADU, accessory dwelling unit, but they're super common here. And so, that 500 or 600 square foot units where my client's going to live, he's going to rent out the main house. The main house, even though it's small in the Bay Area, probably rents for $4,000 a month. And so either something like that, or there's all kinds of folks. And I know for a fact that David Green and his team are helping folks do stuff like this, where you buy a 4-bedroom house, you can rent each bedroom for $1,500 in a lot of different parts of the Bay Area. So if you get it at a decent price and you're subsidizing it by having 3 roommates paying you $4,500 a month, that is helping you pay down your principal while the home is appreciating. And that's essentially just another way of house hacking within a single family. But it's definitely a thing, and it's definitely something that can work in certain markets, right? So that's really a market dependent type of thing. But yeah, if you did that, Joey, the only thing is, because your follow up is like so on multiple times, as long as you're living in it and you've got a reason for moving out of it into the new one, underwriters are going to be fine. They don't necessarily want folks, I guess, gaming the system too much. And so you might buy something that's 1,000 square feet, and then you move into something that's 1,500 square feet, and you move into something that's a little bit nicer part of town. And there's no real rule against doing this 7 or 8 times in a decade. Just be careful, because you're going to be asked to explain it every time. Why are you moving to another single family? Why are you moving to another single family? Why are you moving here? Why are you moving there? I've got clients, trust me, they bought a 4-plex, lived in it, rented out the other rooms, then moved out and bought a duplex, lived in one side, rented the other side, then moved out and bought a single family, lived in that for 18 months, moved out and bought another single family. But each time it was like, I don't want to live in a quad anymore. I want to move to something that's a duplex, right? So they do that. And then they find out later, okay, now I want to live in my own house. I'm tired of living with, a renter next door. And then they move from the single family to a new single family. It's in a little bit nicer neighborhood. It's closer to the school where their kids want to go, so on and so forth. So I don't know. I got a little long-winded there, but you get the point. All right, Rana, how you doing? Thanks for joining. I want to sell my house to my sister. Can I go without a realtor to cut the cost? And can you approve her for more if she pays the car off? You can certainly do a for sale by owner when it's a family deal. And there's a bunch of different creative things you can do with financing. I do all the time gift of equity transactions, which you could do here. But if it's just a straight sale where you just agreed, okay, she's going to pay me $400 for this house. If you guys are, what's the right word for it? If you're sure that nothing's going to come up, right? And you're comfortable with that, then you do it without a real estate agent, without, 18, 20, 30 pages in real estate forms. You're probably going to be all right. Just know that if anything ever comes up, having legal issues with a sibling is probably something you want to avoid. But like I said earlier, if she pays the car off, then she'd be approved for more. I'm not sure if this question is like, approved for more, like she can buy more house. Yeah, the less debt you have, the more you'd be approved for. This is how I'm going to end that one. Are stated income loans good to use? Well, if you don't have other options, then they're good to use. If you're looking at stated income loans versus full doc loans where you're providing W-2s or tax returns or whatnot, then stated income loans, the only drawback is they're more expensive, the rates are higher. And so for those that can't get conventional loans, they're great because a loan with a higher interest rate and with more costs is better than no loan at all for some people, right? And so they're good in certain circumstances. And I know a lot of self-employed borrowers that are doing really well. Their business is booming and they just don't show enough income on paper to qualify. Those are great candidates for stated income loans because whatever the I don't know if there's necessarily a lot of stated income loans out there, but there's bank statements loans where you get 10 or 12,000 a month being deposited into a business account, and we're going to use that income to help you qualify, or you're qualifying based on the debt service of the property you're buying as an investment. But I haven't seen stated income loans. That was something of the past that ended badly. So I just, in my own head, thought about bank statement loans and thought about debt service coverage ratio loans. Those loans are good for the people that don't have other options. Advice on using a 401k for a down payment. I would just say my personal opinion is you don't necessarily want to take out more than you need, but I don't think it's a bad idea. If you have $80,000 sitting in a 401k, if you did a 401k loan for $30,000 and then paid yourself back, because that's what most 401ks will allow you to do. And they call, what do they say? You got to have like a, what's the word? It's one where it's not a tax penalty for buying your first house. And so you're not going to get penalized for it, whether you loan it to yourself or you take it out as a disbursement. But maybe if you've got somebody in your corner who's a financial advisor or somebody who you trust around that stuff, talk to them. But my advice, if you're asking for it, and everybody's different, is take it as a loan and pay it back as soon as you can, because you don't necessarily want to eat away at your future by taking that money and not putting it back, or paying it back slow to where the compounding effect kind of hurts you in the long term. But plenty of people have done it. I mean, imagine the people that did it in 2017, how they feel about it. They borrowed $30,000, put a down payment on a house. That house has since appreciated by $150,000, and they've already paid that 401k money back to themselves. They're feeling pretty good about it. All right, Doug, 162. Don't bother. Just keep chunking. I mean, over 6 years of you paying this thing off, just rough math, you're paying $25,000 plus per year off this loan. So by the time you're a couple years in and you only owe $100,000, the interest amount is going to be fairly small to where the interest savings is. I personally wouldn't do it. And you could probably have somebody show you on a graph like, oh, wait, if you refinance at 2.5%, then over the life of the loan, you're going to pay $4,226 less. And it only costs you $2,800 to do it. So yes, it pencils. But still, like, if you already know you're paying aggressively, maybe you pay it off in 3 years, maybe pay it off in 3.5. I just wouldn't mess with it. I would use the $3,000 or so that would be rolled into this loan and just throw it at the pay down, because it sounds like that's your plan and what you're going to do is aggressively pay the thing down. I wouldn't bother with a refinance. That's what I would tell you if you called me and you were my client. If you're not in California and you want to talk to a mortgage broker and get some local advice, then you're going to go here to greatmortgagebroker.com. Anybody who's followed the channel or watched any of my videos knows that greatmortgagebroker.com, it's a quick 6-question jot form. What state are you in? What are you looking to do? Name, email, phone number, something to that effect. And then you press send, you get connected with somebody, and somebody who's licensed in your state. They'll call you and take good care of you. If they don't, then they get in big trouble with Matt the Mortgage Guy. So if you want a local opinion that you can trust, maybe give them a shout, Doug. But my answer, if you were calling me and you were in California, would be I'd just aggressively pay the thing off. I wouldn't worry about refinancing it. If you had a 5%, I'd refinance it. But the fact that you're 3,625 and you're going to pay it off in 6 years, I'd leave it alone and just chunk it off. I heard 40-year mortgages are being offered to help with being behind with the pandemic. How likely do you think this will happen in the regular market? Great question, Jessica. I think it will happen. And I think that if we continue to go in the direction we're going, where affordability is becoming an issue for more and more people, it makes sense. If the current administration who's in the White House, who is really advocating and pushing to help the, folks who historically haven't been able to buy homes and have been, left behind, if you want to open up some of these barriers to home ownership, making it more affordable is one way to do that. And here's the thing, somebody who makes $250,000 a year and has zero debt and has perfect credit, like those people don't need a 40-year mortgage to be able to afford their mortgage. People who are just getting started, make less than 80% area median income. Those people, in order to qualify for a mortgage, would need a 40-year mortgage because it's a longer term, so it's a cheaper payment. And so my personal opinion is that they probably should. They just don't want to do it at a time where they're fueling demand more than is necessary. So if I had my crystal ball out, I would say as demand starts to cool off, rates maybe tick up a little bit, and housing market gets to a little bit more stable footing. And by stable footing, I mean like it's not so out of whack with supply versus demand and home prices going up 2% every month. Then maybe we introduce a 40-year mortgage that will help more people qualify. I think it would be, and I'm thinking through this in real time. So maybe I started to say like maybe you only offer it to certain people, like certain income thresholds. Like if you make more than this, you can't get a 40-year, so that it's only there to benefit folks who are trying to enter, like some of the bills that we saw that were proposals where you're trying to get somebody into home ownership that they don't have any home ownership within their family, like multi-generational renters. If you want to get them, be the first person in their family to own a home, maybe they get the 40-year mortgages. But if your family has owned homes or you make more than a certain amount of money, maybe you don't get access to this program. Maybe it's that. I don't know. Just spitballing. Just my thoughts. All right, Theo, HELOC versus cash out. The problem with cash out refi is you don't have another property takedown, then you're sitting on the money in some low interest account while you're paying interest rate. True. So you got to weigh it because that's the downside risk to the cash out refinance is you're paying interest on it right away because you're borrowing the money right away. But on the other side of the token is, you've got a home equity line of credit and you might have a variable rate, which is higher risk, or you might have a higher interest rate, which, if you pay a lower rate, but you sit on it and pay interest on money that's not being put to use, but then it gets put to use. Yeah, it's a tough one, Theo, but I still lean towards cash out refinance because I love the idea of 30-year fixed debt. Just is amazing. LE for appraisal is $1,000, but I received from the appraisal company only $480. Yes, the lender will change that in the final disclosure. They're going to put $1,000 in there to cover their behinds because they can't charge you more than that. So if an appraisal on your house, let's say they put $500 on their loan estimate, and then the appraisal management company couldn't find anyone to do it for less than $800, they would be on the hook for that difference. It would be a cure. What do they call it? Tolerance cure. And the lender would have to pay it. So this lender is smart by putting $1,000 in there. If it's only 480, they found an appraiser that accepted it, is doing it for 480, and you pay the 480, you're good. That'll change in the final disclosure. But they did it up front for 1K, and I'll tell you exactly why. Because appraisals are getting more expensive, they're getting harder to get assigned, and so that was just a just in case. Yeah. See, I'm glad I have Maria. Maria is my CPA of the group. She's here in case there's any CPA questions, and I couldn't find the words for the 401k exemption. But if it's your primary residence, you get that exemption on your 401k withdrawal. And so I think it's the same, right, Maria? Whether it's a withdrawal or a loan. God, they call it something like a hardship withdrawal. And I always thought it was funny because it's like buying a home isn't a hardship, but it's like if you have a medical event and you needed, $50,000 in medical bills to be paid. I think that's another one of these exemptions, and it's called a hardship on all of them. But thanks for the insight, Maria. She wants to remind everybody it's principal residence only. Hello. Make sure you're here every week. In case we have any CPA questions, we're going to ask you, whereabouts in the country are you a CPA? I'm just curious. All right, Valerie. I have a 3.5% rate on my mortgage. Thinking about refinancing. Been in the house for 13 years. I have a 30 year. Should I refinance? I have 30 mortgage. Okay, so we got to clarify a few things. You've been in the house for 13 years, but how long have you been in the mortgage? Because you might be in the house for 13 years, but then you said I have 30 mortgage. So maybe you've only been in this 30 year for a year. You're at an interest rate where you're going to have some sort of need to refinance, unless you have a really high balance. I've done a lot of loans in California, and this might not apply to everybody, but if you go from 3.5 to 2.875 on a big enough loan balance, that thing pencils real quick. If you've got an $822,000 loan balance, which is the conforming limit, 822,375 in California in the high cost counties like San Francisco, Santa Clara, LA County, Orange County. Just that, 0.5% from 3.5 to 2.875 is going to be humongous savings. $500 a month interest savings. And so yeah, if you're in a big loan balance, then you might want to refinance. Or if you're in this loan, I don't think you've been in this loan for 13 years. You said in this house for 13 years. 13 years ago, rates weren't that low. So my thought is that you've probably been in this loan for less than a couple of years. You're probably going to be set if you're like $250,000 loan balance or less. If you're north of 300, maybe you want to look at what the interest savings is. And this conversation, like most all my refinance conversations, it's just math. It's just cost versus benefit. Let's say that we could get you a 2.99 with 0 points, but all the loan costs are $2,500. We don't need an appraisal. We just got to pay the title company and the flat fee to the lender. Well, if you're going to save $200 a month and it's going to cost you $2,500, the thing pencils in a year. Then I just ask you, hey, Valerie, how long do you plan on staying in this house? Oh, we'll be here for at least the next 8 years until my son's out of high school. After that, who knows? Maybe we'll move. Maybe we'll stay put. I don't know, but at least 8 years. Okay. Well, if it pays for itself in a year and you plan on being here for at least 8 years, then probably pencils to refinance. All right. So Maria's in LA. If anyone needs a CPA in the LA area and Maria's not too busy and can take you on as a client, then we'll give you a call. Linda Gomez driving through LA right now. What you do? You got your laptop up, just driving through LA traffic. That's how bad LA traffic is. Just sitting on the freeway and joining the conversation on a mortgage broker Q&A on a Monday evening. All right, I'm gonna try to cut us off at an hour and a half, and so I'm about an hour 15 in. This is gonna be final call. It's gonna be last call for mortgage questions. Give me what you got, guys. I've got a couple notes on things that I'm going to make a promise on live streaming YouTube right now that when I have these really good questions that get asked, sometimes I write them down and I'll be completely transparent and honest. Sometimes I just forget, right? This is going to be my new thing is I'm going to come back the next week and I'm going to answer them so that I hold myself accountable to actually going out and finding the answer. Home equity lines of credit on investment properties. I'm going to find out how common they are, what banks offer them. More than likely, it's not going to be with a broker like me. It's going to be referring you out to somebody else who does them. And then whoever asked me about stats around how elections affect the housing market, it'll be fun to look that stuff up. And I'm going to put a note here to call Ryan. Because Ryan Lundquist, SacramentoAppraisalBlog.com, he's the guy that I love. Not only all the work he does on stats and graphs and stuff, real estate market trends, but just how he presents it. Because he's the type of guy that just the proof is in the pudding. The numbers say what the numbers say. It's not what I feel or what he feels or what anybody else feels. The numbers don't lie. Let's see if I can add anything to this list of things. Where do we go? New comments. All right. A lender with Cornerstone in Oklahoma City that has great reviews. Well, that's probably good. Here's what I would do if I was you, Joey. Go to greatmortgagebroker.com, fill out that quick form. You'll get contacted from somebody in Oklahoma City. U Mortgage has offices there, and they're a great broker who I like and trust. I know from top level executives down, they run a good operation and they do good work and they run on thin margins. They can offer you a great interest rate. Call them, get with them. And here's my advice to anybody who's in the market, whether it's refinance or purchase. You're generally going to get a pretty good idea from the start whether you like and trust somebody. And so, that Cornerstone Oklahoma City had great reviews. You either talked to them and felt it and felt like, man, they got great reviews because they're really good. They answered my questions. They were super cool and streamlined and had systems together. How I got pre-approved and what they presented with me and the numbers they showed me and the advising they gave me was really high level. I liked them. Or you're going to have an experience that's like, that wasn't cool. And so you do that with them, you do that with U Mortgage, and you just go with whoever makes you feel like they're going to provide you the best service, educate you the most throughout the process. And like most people are looking for, right, you're going to get the best deal. Because I got to make a video on this sometime in the near future too. Not all mortgage companies operate on the same margins. You can literally be this identical borrower, 800 credit score, $400,000 purchase, 10% down. One lender is going to be 2.99% with 0 points. Another lender is 3.375 with 0 points. And the only difference is 3.375. A branch manager is getting paid, a district manager is getting paid, marketing department's getting paid. The building they operate out of is fancy and nice. And so that's got to be paid for, and so they're operating on margins where everything's getting paid and you, the borrower, is paying 3.375. Or, you go to somebody who can give you a 2.99% interest rate and they're getting paid directly from the wholesale lender they're brokering the deal to. Period. The end. There's no fluff. There's no extra pieces and parts and management structure that has to get paid. And so, that's Another long-winded answer, but hopefully some color, some clarity, some value. Thank you, Valerie, for joining. I appreciate you. Come join us next Monday. Linda, I appreciate you. No problem. Just a girl living healthy. Well, I'm glad you're living healthy. That's the way to do it. Only got one life. And so on 4th of July, I was out of town on vacation. I still ran 8 miles because I've got this new kick where I'm trying to run 1,000 miles this year. And it's cool on your app, on your phone. It'll show you like how your heart is getting stronger. Be surprised. You run 20, 25 miles a week, your heart gets stronger. I'm trying to live to see my great grandchildren. So I'm just a boy living healthy, and here's just a girl living healthy. 291,000 finance, 2.875 on a 30-year fix. It's a great loan. And so you received a settlement for 100,000. Now, here's my personal opinion. You could, and here's the math that I would want to do before I did that if I was you. You could apply 100,000 towards principal, and most lenders will recast the mortgage. If you look on my channel for a recast mortgage, it'll tell you exactly what that is and how that works. Here's my thought and what I would guess. Let's say that 291 plus taxes, plus insurance, plus everything. I don't know your rate. I don't know what state you're in with taxes, but let's just call the payment $1,800 a month. The taxes, the insurance, a lot of that stuff is going to stay the same even when your principal changes. So some of it's fixed. Let's say it's going to take your payment from $1,800 to $1,500. It might take it down more. Taxing $1,400. Let's call it $1,400. Throwing 100 at it and recasting. Now, depending on your specific life situation, that $400 a month might be really valuable. But for a lot of people, myself included, I would rather have $100,000 in the bank, emergency fund, whatever the heck you want to call it, than saving $400 per month on my mortgage. Now, if you're in a situation where you're like, I'm on a fixed income, $1,800 is a little bit of a stretch, and I'm constantly digging into my savings account every month to pay it, then maybe you do want to do that recast, apply it. And here's the thing: as I'm saying it out loud, you can land somewhere in between. You could put $50,000 in the bank and $50,000 towards principal. What I would probably do, I wouldn't even mess with the recast. I would have the $100,000 as an emergency fund, and maybe, as you think about what you want to do in the future, you apply smaller payments towards principal, $500 a month. Then after 6 months or a year, you reassess it. Do I want to continue to be aggressive and pay this thing off? Or is it better to have this money sitting in the bank? Or maybe, with a safe investment, you can get 4, 6, 8% returns on that $100,000. And that's doing better for you than paying off this sub 3% mortgage rate that you're writing off the interest on your taxes. I mean, I lean towards not paying off that super low interest rate mortgage debt, but that's my opinion. Best of luck to you. It's a good it's a good problem to have. And then I guess your follow up is you've already got the emergency plan and 100,000 in the bank. So I mean, if the monthly savings of paying it down is something that is really attractive to you, and that's going to be the best bet for you and your family, then do that recast. Recasts are relatively easy to do. Most lenders do them. I just call the current servicer and make sure that you can do that recast. All right, $292,000 balance, 20 years left at 3.5. The house is worth $750,000. Is it a good idea to take some equity and buy an investment property? These are such hard questions for me to ask. Little old me. Depending on where you're at and what's available investment property wise, it could be a good idea, but everybody's different. Some people would say, of course, you can go up to 60% loan to value on this thing and pull out 150 grand and have a $450,000 balance on a cash out, you could lower your rate. On a cash out 30-year, if your credit is good and you're staying at 60% loan to value, your rate is going to be lower than the 3.5% you have right now. I know that offhand because I've done a ton of cash out refinances lately. And by going to a 30-year and stretching that back out, since you only have 20 left, your payment's probably not going to move that much. You're probably going to have a $450,000 balance. Your payment's not going to be that much higher. Take that 150, invest it, see a great return, and that's going to be great. It comes with some risk. You're borrowing more money against your primary, and the problem that some investors have right now is there's so much money chasing yield. There's so much money looking for investments that's hard to find really, really good investments with that money. So yeah, it's a personal thing. I don't know if there's necessarily a right or wrong answer, but if you can borrow money at 3.25 on something that's going to be 10% cash on cash return, that's always a good idea. And so that's my final answer to you. Is it a good idea to take equity and buy an investment property? If you can and find the best or the right investment property and deploy this money correctly, excellent idea. It's not for everybody though. Thanks, Zita. Appreciate you being here. Appreciate all the feedback on all the videos I do. I see the name on many, many videos, and I appreciate you. All right, D. Scott, you did come too late, man. Next Monday, be here, 6 p.m. Pacific Standard Time, sharp. We can start off answering the questions that I wrote down for this week and talking about jumbo programs. I'm happy to, because as you know, California's expensive. Jumbo is a market that a lot of folks play in California, and I've done more this year than I've ever done before. Houses are getting more expensive is part of the reason, but yeah, we could talk about different products that are available. One of my favorites is 10% down jumbo. We'll talk about that next week. Live and rent in SoCal. Purchase a second home in Phoenix with the intention of making it my primary. All right, things changed. Would I be able to rent the 1-1 to my niece without violating the second home rider? I'm fairly certain. I would double check, but I mean, things change all the time. I mean, you can buy something as your primary residence and get a job across the country 6 months later. You move, you rent that house out, things change. It happens all the time. And you wouldn't be in trouble. Like, you bought it as a primary, why are you renting it now? Things change. So my gut says you wouldn't have any issue at all, but might want to confirm. How long did it take for a home to foreclose? The stats from like the past foreclosure crisis said it took like a year plus in a lot of markets. It's market dependent, but a lot of things are happening in today's market where servicers, the government, they're doing everything they can to stop foreclosures. They know that it hurts families, it hurts communities and whatnot. And so if you or anyone you know is struggling making your mortgage payment, make sure that you do all you can to at least look at the different resources, the different programs that are available to you, because there's a ton out there right there. But between modifications and other programs that are being offered, if you're struggling, there's help out there with forbearance and all the things that are tied to forbearance. So I appreciate everyone that watched. I'm going to get this thing over and done with within an hour and a half every Monday, 6 p.m. Pacific Standard Time. Please, if you got any value from this at all, smash the like button for the YouTube algorithm. Share it with friends. Share it with family. Let me know how I can help. If you're in California, just shoot me an email, matt@mattthemortgageguy.com. If you're outside of California, you know by now, greatmortgagebroker.com is a broker who's licensed in your state, who I like and trust to take good care of you. Just take less than 30 seconds, 6 quick questions, and where you're at state-wise. It'll connect you with a broker who is licensed in your state. It's going to give you good, honest advice and be able to lend to you because I can only lend to you in California. I've got too much business in this little old state to be venturing out and doing other stuff, but I can certainly give advice across all 50 states and enjoy doing that every single Monday at 6 p.m. Pacific Standard Time. Thanks for watching. Appreciate you guys. See you next time.